Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for August 16th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Good morning, Ken. How goes it?
We need to get, I'm not feeling, even though we should be more balanced with two of us, I feel like we need to get some I don't know, variety in here. So we're working on some guests.
Yeah.
Maybe a long-term replacement host for Ned. It just feels lonely with just me and you. Although there's no one I'd rather keep company with than you on the morning show.
Yeah, thank you. I almost didn't make it this morning. I was out for a bike ride, and the saying "hit by a Mack truck."
Yeah. Oh God.
I was out for a long bike ride, about an hour and a half bike ride. And I'm sort of halfway into it, and I hear this Mack. It's got Maxidine engines have a very distinct engine, and I heard it coming behind me, and I thought, this guy is really fast and close. And there was two cyclists ahead of me, and there was about a foot in it when he went past me. So he was, and then he pulled up. Then he pulled up half a mile up the road to talk to another guy. So it was all for nothing, but it was so close. It's ridiculous.
And that would be very ironic, because I figured if you're going to get hit by any kind of big rig, you'd want it to be a Peterbilt.
I did, yeah. I said that same thing to the guys. I said, I wish it would have been a Peterbilt. I wouldn't be so angry.
That's funny. All right, so near misses aside, we're here every week talking about freight markets, trends. We're seeing data. We have some super special data here at the end. We're going to take a peek at our long-term forecasts. Spoiler alert. But most importantly, answering your questions. The past few weeks has been absolutely terrific. We've gotten records numbers of questions, too many for us to even handle. So I really encourage, if you want to get your question answered, go ahead and get it in early. I'll be in the chat. We have our marketing team in the chat. We'll be getting to those questions at the end. But for the sake of getting any more questions, I'm going to pop over to the key points of the week. So dry van rates dropped below 2020 levels, but still high historically. I think the next real comp we're looking at is where we stand in relation to 2018. So we'll be monitoring that as we get into the fall. Contract dry van rates, new rates entering the routing guide down about 5%. Again, what we would expect. Contracts are constantly being rebid. So this is not outside of what we would expect. Michigan State Ton Mile Index up 3.8% year over year in June. Again, this really interesting shift in import volumes, which Dean's going to cover more from west to east, has been super fascinating to watch, especially given where we are in the ocean shipping season. Again, we saw EIA's fuel number come out last night. I lost about another 8 cents. It seems some of the decline seems to be losing steam. That'll be important to watch here as we get into the fall. And then Brake Safety Week is next week. Capacity impact is likely. I'll turn it over to Dean to walk us through the market update. Take it away, Dean.
Yeah, thanks, Ken. One of the things I've been noticing all year with carriers is they're taking a lot more time off either side of long weekends because they had such a good year last year. So I expect Brake Safety Week next week will see a decrease in capacity. All right, so let's jump into the market update. Dry van load-to-truck ratio. Load post volumes have been dropping for about 3 weeks. Last week they were down 6%. They're still about 37% lower year over year, but about 21% higher than 2018, if you want to use that year as a reliable benchmark. Equipment posts down 3% last week. They're about 8% higher than the oversupplied 2019 market for mid-August. As a result, last week the load-to-truck ratio dropped to 3.30, or almost about the same level as 2017. In the refrigerated market, volumes cooled rapidly last week. Volumes are down 12% week over week and about 46% lower than this time last year. Carrier equipment posts were up 4% last week and about 12% higher than the same week in 2019. Load-to-truck ratio dropped slightly to 6.57. And in flatbed, load post volumes have dropped almost 40% in the last month, following last week's 7% week-over-week decrease. Volumes are now about 51% lower than last year and about 9% lower than the hot flatbed market in 2018. Equipment posts are about 6% higher than the prior record high in 2019. All of that activity dropped the load-to-truck ratio to 13.35, which is very close to 2019 levels, as you can see. So let's have a look at our market condition index, a quick look around the country. Following July's surge in imports and vessel congestion offshore, accounted 43 vessels waiting off Savannah yesterday. Dry van spot rates from Savannah to Atlanta hit a 12-month high last week at $9.93 a load. That's about $13 per load higher than the previous year. In contrast, spot rates to other longer haul destinations destinations, including Dallas and Miami, decreased by about 25 cents per mile since the end of July to $1.27 and $2.84 respectively. Jeff Lynch, the CEO of Georgia Ports, had a press release out yesterday saying that he expects import volumes to begin slowing following July's high numbers. He expects that volumes will, on the import side, will decline 1.5% year over year in the second half of this year, and that's based on current volume of imports on the water. So it certainly seems that peak shipping season is here or just moving past it based on July numbers. Further north in Elizabeth, New Jersey, the number 2 port in the country, spot rates to Atlanta have been steady at $1.63 for the last 10 weeks. That's about 37 cents per mile lower than this time last year. Loads from Chicago to Atlanta are up slightly to $2.18 this week, but still around 70 cents per mile lower than August last year. And having a look at volumes on the West Coast in Los Angeles to Chicago, rates are up approximately 10 cents per mile over the July average to $1.84 this week. They were almost $1 per mile higher this time a year ago for contrast. Imports into Los Angeles have translated into fewer spot loads at the moment. The decreasing volumes there to nearby warehouse markets like Phoenix are dropping. Spot rates are at their lowest on that lane in 12 months at $3.28. They're almost $1 a mile lower than the previous year and just $1.50 mile lower than last year's high of $4.81 recorded in November from Los Angeles to Phoenix, where a lot of import volumes were being stored. Having a look at the refrigerated market, produce season is in full swing across the country as more regions enter their peak harvest season in August. One area that is coming online right now is Michigan. Outbound spot rates are showing some movement. Loads 320 miles away to Chicago from the Bay City, Saginaw area are averaging about $2.85 per mile this week. That's about 15 cents per mile lower year over year. Loads from Saginaw to Hunts Point in Brooklyn, New York are averaging $3.50 per mile this week. That's around 32 cents per mile higher than the July average, but still 62 cents a mile lower than mid-August last year. Having a look at the Pacific Northwest, spot rates from Pendleton, Oregon to Los Angeles are averaging $1.41 this week. That's up 20 cents a mile in the last few weeks. But still around 20 cents per mile lower than this time last year. Interesting news yesterday from the Washington State Tree Fruit Association. They're reporting that the current apple crop will be down about 11% year over year following a cold and prolonged spring. In Los Angeles, spot rates for loads east to Phoenix hit their lowest level in 12 months in the refrigerated sector at $3.38. That's almost $1.40 per mile lower than August last year and about $1.74 per mile lower than November's peak last year. A similar trend was reported for reefer carriers from Los Angeles to Las Vegas. Spot rates hit a 12-month low of $4.68 per mile. That's more than $1 per mile lower than this time last year on that lane. Spot rates from Fresno to Brooklyn, long-haul lane dominated by team carriers. Rates continued to cool last week, down 13 cents a mile below the July average at $1.99. Last year, the same loads were paying $3.34. Having a look at the flatbed market, capacity continues to loosen on some key lanes, especially Los Angeles to Las Vegas. Spot rates reached a 12-month low of $3.65. That's almost 60 cents a mile lower than this time last year. At $2.35 a mile, loads from Los Angeles to Salt Lake City are now $1.43 per mile lower than this time last year, while loads to the same destination from San Diego are around 40 cents per mile higher at $2.74. We often see a lot more break bulk steel coming into San Diego versus the Los Angeles ports. In the Pacific Northwest, flatbed capacity is tighter. Spot rates for loads to Salt Lake City at $3.06 per mile this week. That's just 6 cents a mile short of the 12-month high set in March last year. That was from Portland to Salt Lake City. Portland to Stockton is another busy lane for flatbed carriers. Rates are around 45 cents per mile higher than this time last year, averaging $2.51 per mile this week. And to Los Angeles out of Portland, loads are averaging $2.08. After decreasing by around 20 cents per mile since May, spot rates for loads from Houston to Fort Worth, one of our number one or two busy lanes, depending on the week. Spot rates increased last week by 4 cents a mile to an average of $3.77 for loads this week. Loads 350 miles east of New Orleans out of Houston averaged $2.66 after decreasing by 42 cents per mile since April this year. Loads further east to Lakeland, Florida out of New Orleans dropped to the second lowest level in 12 months at $3 per mile, while loads from Lakeland north to Atlanta were flat at $1.45. Census Bureau data out this morning on residential construction shows that the flatbed market continues to cool. Building permits were down 4.3% month over month. They're now down 11.5% year over year. The single-family housing market, which is the most freight-intensive in the flatbed sector, single-family housing starts were down 10.1% month over month and now 17.6% year over year. In July, we built 103,000 fewer single-family homes, and compared to July last year, in this July, we built 196,000 fewer homes. About 56% of single-family homes are constructed in the southeast of the country. July volumes were down 17% and 23% year over year in the southeast. So wrapping up our market update with our year over year look at spot rates. After remaining relatively flat for the prior month, the national average dry van rate dropped 2 cents a mile last week to $1.95, compared to our top 50 lanes at $2.39 this week. The national average was about 44 cents a mile lower. Dry van rates were also about 45 cents a mile lower than this time last year, but still about 35 cents per mile higher than the average of the pre-pandemic years for mid-August. In flatbed, there was very little change in the national average reefer line haul rate last year. Remember, these rates exclude fuel. At $2.26 a mile, spot rates have increased almost $1 per mile since the start of the year. Decreased almost $1 per mile since the start of the year, and compared to this time last year, about 52 cents per mile lower. And in flatbed, wrapping up our market updates, spot rates continue to track seasonally with 2018, as you can see from the chart. Last week, rates were down about 4 cents per mile and are now 4 cents per mile above those 2018 levels, but closing in very close on those numbers. The national average flatbed rate, excluding fuel, dropped to $2.38 per mile last week. That's about 32 cents per mile year over year lower, and compared to prior pandemic years, pre-pandemic years, still about 38 cents per mile higher. And that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. And with that, it's over to Ken for the short-term forecast.
All right. Thank you, Dean. So this week, as I mentioned, we're going to do something a little bit different. We're going to do the short-term forecast like we always do. And then we're going to follow that up with the long-term forecast based on a bunch of inbound questions we got over the last few weeks. So let's start with our short-term. So blue, this is dry van, long haul, 7-day rolling average rate per mile excluding fuel. The blue line is historic, as observed by DAT. The green line is RateCast, which is our flagship production forecasting model. The red line is our short-term forecasting model, which weights near-term history a lot more heavily than RateCast. And then you have two blended forecasts. So you have the yellow and the gray line that represent different blends of our two primary forecasting models. So the takeaway, the so what here, is a very similar story. I've been reporting out on these the past few weeks, and basically we've been flat. We've been hovering around that $1.95 a mile line. The blue line has been tracking. It's been tracking very close to what we've been forecasting. It'll be really interesting to see pretty much through the end of this month. There's pretty much unanimous model agreement amongst the ensemble here of the four models, with RateCast getting a little bit more optimistic as we head into Labor Day and the first couple weeks of September. So that'll be very important to watch. Let's move on to reefer. Very similar story. Different levels, different historical pattern, but almost the exact same forward-looking forecast. People are going to be buying a lot of hot dogs and hamburgers, Labor Day parties, back to school, college football, NFL. There's a lot of events going on, so I wouldn't be surprised if there's a little bit more optimism baked into this forecast than we might be seeing right now at the ground level. So it'll be interesting to see on the refrigerated side. Plus, it's been hot, right? Moving some of that stuff in the, what do they call it, the heat belt that set in could be a little bit of a boon, if you will, for the reefers. And let's move on to flatbed. Again, I've been talking about this one. Seems a little bit hope and prayer to me. That's a bit of an exaggeration. I don't think it's that optimistic. Pretty much all the forecasts are in alignment over the next week or so, and then RateCast is expecting quite the turnaround. And again, these aren't huge amounts. It's not expecting 30, 40 cents of upside. We're looking at, if I squint, 15 cents or so of upside baked into the RateCast model. I'm not exactly sure what it's thinking about when it's projecting that optimism. I think A lot of the things Dean laid out would indicate more downward pressure, the seasonality as well that we've seen, like if we look in model 18. But, again, if we get some tropical weather, if we see any sort of disruption in supply of goods used for heavy manufacturing or home supply, that could nudge this forecast, nudge these actuals upwards. So with that, that's our short-term forecast. And I'm going to turn it over to Dean for our question of the week while I get set up for the long term.
Yes, Ken. The question of the week that we'd like to throw out is, as we look to the holiday shipping season, what's the long-term rate outlook?
That's a great question. And luckily, there's a DAT for that.
Right.
I love looking at these charts, mainly because I'm a giant dork. But I refresh these almost weekly, and Dean and I usually talk about them while our West Coast coworkers are still having their coffee or in bed, because Dean and I are both on the East Coast. But I love this view. I created the view just like this when I was in the industry. And just a level set, because it's been a while since we've showed this. The blue line is the historical actual. And again, there's one small difference here. So you'll notice that y-axis, the levels are a little bit different. I'm very partial to stripping out everything but the longest haul shipments for this. Okay, so I take out anything under 550 miles. Pretty much all of DAT's other reporting is 250 miles. I still think there's some short haul, mid haul, fixed cost amortization that happens between 250 and 550 miles. And for this, I'm not using this chart to move freight. So I don't care about the absolute rate per mile in this chart. I'm trying to find just directionality in magnitude of rate changes, both historical and future. So FYI, that's why the y-axis is different. So you have blue historical, gray is the year-over-year percent change. That's the right-hand y-axis. And then you have three models, and all three of these are rate cast. And I know it's a little bit confusing, which is why we don't typically show long-term and short-term in the same show, but I think y'all can handle it. So the blue dotted line is the rate cast average. The green dotted line is the optimistic or high case. The red dotted line is the low case. And then the gray moving forward is the year-over-year change, presuming the middle case, right? The blue dotted line. And I think this is just fascinating. So rates have obviously come down, right? We know that. But you can still see they're well above where they were in 19. They're right, they're still above where they were at this time in 18. And then I think the dotted green line is where we've been trending over the last few weeks, oddly. But I do think that's a little bit overly optimistic as we head into the fall. If I were a gambler, I would probably put the truth somewhere between the red line and the blue dotted line, at least through the balance of the year. You can see the pessimistic case has us kind of dipping almost down to 18 levels, and the base case has us staying way above 19 heading into this time next year. What do you think, Dean?
Yeah, I think that certainly fits a lot of the economic narrative we've been talking about, and other market experts have been pointing towards a big slowdown in early 2023. I think that's where we'll see that bottoming out of spot rates and contract rates in that first quarter. It just feels like that this year it's going to take the rest of this year for our supply chains to sort themselves out. But the way that imports are shaping up, if that's a good barometer for things that we carry in the broader truckload market, that is going to be a pretty quiet period for imports in the first quarter next year. So I think that all fits with how I see the market going, relatively flat to slightly up between now and Thanksgiving. And then there's that looks like about 10 cents per mile decrease there in the first quarter. That certainly fits what we see historically.
All right, so let's move on just to kind of get through the charts, and then we can discuss even more. Let's move on to reefer. I don't think there's a whole lot to say here that wasn't said personally for dry van. I think the forecasts are much more aligned through the end of the year, which is what you would expect. Reefer does follow a much more concrete seasonal pattern than dry van, right? It tends to adhere to the seasonality more than dry van. So you're seeing a rather agreed upon balance of the year. What I find interesting is the low case, right? The red dotted line has the bottom really falling out after essentially the turn of the year. essentially after Thanksgiving, really. I mean, I know it's a little hard to see where these numbers, there's a long history here on the bottom. Whereas the high case, again, I think that's a bit optimistic pending a major disruption. With the base case still having a fall off, but sort of settling out way ahead of 19 and probably somewhere close to where we were in 18. Dean?
Yeah, I think that fits. A little bit of a bump around Thanksgiving there. If you follow the blue chart from where we are now, it looks like it's up about 10 cents per mile. But then you can see the holiday activity and the higher demand for refrigerated freight driving up rates to around $2.30 per mile at the turn of the year, and then they come down. You'll see that lull typically, and then once you get to April, they start to pick up. But not much of a bump in the model forecast for the start of produce season next year. It's kind of about where we are now, which is an interesting forecast. If you look at where 7.5 is on the chart, we're not far off that right now.
Yeah. And again, what I said before, I think the short-term forecast is what I'd be using to move freight now. These are what I'd be using for RFPs. And I wouldn't be using a national chart, right? We generate, I think, 6 million forecast data points every single day long-term. All the different lanes, all the different equipments, all of that stuff. So this is what I'd be using for an RFP. I wouldn't be using this to move freight today or tomorrow. I'd be using the short-term forecast for that. All right, here's the spicy one. I'm moving on to flatbed now. So you can see here, 16 followed a very similar pattern to the other two equipment types, and then we saw craziness in 18, and then it cratered, and then it's just been on an absolute tear, right? The home building, the remodeling, the construction, all the stuff that's happened over the last few years has really whipped flatbed up into a frenzy. But kind of on a sneaky side, it's been down quite a bit here over the last few months. And again, I don't know what the green dotted line here is smoking, but again, pending and hopefully not related to a large natural disaster. I think that's pretty much what would need to happen for that green line to manifest, at least through the end of the year. And again, we're not hoping that happens. Again, the best we can hope for is like 5 major fish storms in a row, right? Where big Category 5 hurricanes come up and then they skirt off and go back out into the ocean and don't cause any loss of life or property. I think here, it's really going to be important to watch where things settle. So there's differing opinions amongst the low forecast in the base case on where things settle out. The base case essentially has it losing steam somewhere around Halloween, and then perhaps starting its tick back up. The low case has it losing steam or right around the same time, but at a much lower level, but then not really picking back up, and then almost starting to dip back down again heading into next spring. I think that's a pessimistic outlook on the broader economy, especially around housing starts. But Dean, how do you interpret what we're seeing here?
Yeah, I tend to agree with the pessimistic, your comment there about that. I think the red one is a little bit too pessimistic. The blue line feels more likely to be in line with how I see the spot market. If you go back to the 2017 period, you can see those couple of big spikes when those 2 Cat 5 hurricanes impacted the freight market in the southeast. We're still a long way from being through hurricane season, so that could change things in the flatbed market in the southeast. So that's why I think that we'll see this uptick, or holding relatively close to the blue forecast. What's interesting there is that the forecast is picking up on the kind of the increase in building and construction activity. Steel volumes peak in terms of tonnage move in March each year. Machinery levels on the import and domestic side peak in March and April, getting ahead of the harvest season. So that's why you're seeing the optimism there on the blue line. I think that'll follow pretty much to trend next year. We're not seeing any other big alarm bells in the building and construction industry. It's more so the housing industry that's cooled right off at the moment. And of course, that'll be the direction of that will be determined by interest rates and how quickly they change, assuming they do.
Yeah, I was going to say, I mean, it's not, again, I have one state school degree and I'm working on another one. Right. So my mind's rather simple, but who would have guessed that interest rates at 3x what they were a year and a half ago and 2 straight years of insane, unsubstantiated increase in housing prices would have slowed down the housing market? I mean, who could have guessed? Who could have guessed that no one can afford a home, and they certainly can't afford to finance it anymore. And then even if they bought it, they couldn't afford to put a deck on the back.
Right.
So again, I think it was bound at some point to cool off. And we're just seeing that now. So let's get these graphs off the screen and get to some questions. How's that sound?
Sounds good.
All right. We got a ton.
All right. I'm just trying to bring up the first one here. August, Gary Bates, August is slow because of being too hot to work.
Sure as hell is too hot to golf.
Exactly. It's traditionally a quiet month, right? August is typically very quiet anyway. So, I think that's part of it.
I've and again, I'm just going to totally dork it up today more than usual. I've been out of the industry for coming up on 3 years now, and I still have like the freight seasons ingrained in my brain, right? We're like crazy, like month end, quarter end, 4th of July you have, and then you kind of cool off, if you will, even though it's heating up in the late July, early August, and then back to school is when you typically start to see freight tick back up, and then Labor Day usually kicks that off, and then you're kind of really ramping up into the retail peak in the fall. So I think it's a typically slower month. I don't know that the heat has had too much to do with it. I think it's been giving some support to reefers for sure.
Right.
Especially on some of those more northern east to west and west to east routes. So something to keep in mind for sure.
Yep. Wyatt Walsh asks, does the whole Amazon thing, I'm not sure what the Amazon thing is, possibly affect some of that West Coast situation? I guess Wyatt's referring to the declining volumes and the lessening of congestion. I'm not sure what the Amazon thing is. We may have to take that question on notice unless, Ken, you've got some insight.
I don't. I have appreciated Wyatt's comments in the chat here, and his call out on Prophet was very interesting, right? So for those not familiar, Prophet, I think, is the Facebook open source forecasting algorithm. I could be wrong on that. And it's always interesting. I think in our field now, we think a lot about balancing model explainability versus model efficacy, right? So a really, really wicked, awesome model that we can't explain to our customers and users kind of is an interesting balance between value, right? Maybe a simpler model that's easy to explain what's pushing it up or down that isn't as accurate or as effective sometimes can provide more customer value because they want to add some of their own assumptions. And with some of these really big neural nets or black box models, if you will, it's hard to explain what's pushing up or down. So it's a really interesting time to be in the field, especially within the freight industry.
Yeah. Rayleigh Melton asks a good question. Is there a calendar I can reference for freight events such as Brake Safety Week next week? And I think the answer is, I'm not sure. I don't think we have one, but it's a great idea. We need to build a freight calendar with all of these on there. I did have one up for 2021. I haven't updated for this year, but we'll take that as an action item, Rayleigh. Thank you for the question. Mitch asks, any new thoughts on the new truck rule in California looking to ban trucks older than 2009 to take effect early 23? Ken, your thoughts on the capacity impact of getting these older trucks off the roads in California on top of CARB and AB5?
I mean, I don't know. I mean, it's certainly not going to make it cheaper.
No.
It's certainly not going to provide more capacity. It's not going to incentivize investment.
Right. Right.
And when I mean investment, I mean domicile trucking companies.
Yep. Well, there's some rules there that are making the manufacturers make a certain percentage of electric trucks. And of course, there'll be subsidies for carriers to buy electric trucks. But that's just going to cost more money. Everything's going to cost more to move freight in and out of California. I think it's just going to tighten capacity and drive up, freight rates across the board there.
I know. I'm not pessimistic about this. I think what I am is I'm skeptical, right? I mean, so was it part of the act that was just passed in Congress included incentives for electric vehicles? I think it was a $7,500 incentive. Quite literally the next day, I think it was Ford and the Ford Lightning, which if you're not familiar is the electric F-150, raised the price of the truck by $8,500. So I grow skeptical. I grow ever the more skeptical because I usually operate from a baseline of skepticism. I grow ever the more skeptical that these sort of things aren't just purely inflationary across the board. What I haven't figured out yet is to what end. I guess I haven't followed the money far enough. But yeah, it's going to make it more expensive. It's going to make it harder to find capacity. People aren't going to want to set up trucking companies. People aren't going to want to operate in California.
Yeah.
But the long and short of it is the global maritime infrastructure is not equipped to move freight overnight outside of those ports. I mean, what we're talking about here is like, the East Coast being busy by getting what? I mean, it's such an extremely small fraction of that West Coast volume, right, Dean?
Yep.
So it's not, I don't care how deep you dredge the port of Savannah, you're not going to handle half. Even if you just lobbed off Long Beach from LA Long Beach, Savannah can't handle that anytime soon, in addition to the stuff they already handle.
Right.
So what you're looking at is the winds of change would have to blow over probably decades for the global shipping industry to divorce itself from California.
Yep.
So
great point. Last question we've got here, Jacob James. If you were an owner-operator, in what area would you put your reefer truck to work? It's a great question. Any northern latitude right now, I would be north of I-40 and all the produce markets. You've got the Yakima Valley is pretty hot at the moment. A lot of volume moves between Washington State and Michigan. That's a good lane to run apples. And then you've got a lot of cheese coming out of Wisconsin. Michigan produce season's coming online. Northern latitudes, a lot of volume heading south. You've got to be very careful loading back north because you'll have lower volumes. But I'd be running some of those north-south lanes coming out of the northern latitudes if I had a reefer truck right now in August.
I heard a great tip the other day. People getting the permits that they need to haul wine. So this extended heat dome thing has caused major delays on the shipments of wine from the West Coast east, right? So they're holding shipments is what they'll typically do. Even to the extent that a lot of carriers that are hauling typically medical, so pharma, typically not your clinical trials or the stuff that requires validated temperature control. Think more of like whether it's over the counter or generic pharma. They're participating in some of these wine shipments because there's been a huge boon for wine, obviously through COVID, for obvious reasons, and there just really isn't a lot of infrastructure to support temperature controlled shipping. So that's an area where if you have the flexibility, if you have the interest in it, you could potentially get some really nice paying loads for heading west to east, shipping wine.
Good point. That's all the questions we've got today, Ken.
A lot of great comments, a lot of great discussion. I really appreciate them. I'm thankful that we have such an engaged listener base. So with that, I am going to wrap us up because we're running a few minutes long. Dean, plugs for the week.
Yeah, as always, Sales Chatter tomorrow, 9 a.m. Eastern with Dan Deegan and DJ Flores. Landline tomorrow night. Don't forget, I'll be on Road Dog Radio Channel 146. Freight Finds Out. Don't forget the latest podcast with Chris Kaplis and Leah Shaver from NTI talking about driver pay. Of course, we've already covered Brake Safety Week as next week starts this Sunday. And, of course, DATCon, DAT's user conference is coming up on October 5 to 7.
Yeah, we have DATCon. I'm sure we're going to have presences at McLeod, CSCM. I know CSCMP, Mercurygate, TIA, Technovations. It's going to be a busy fall. Yep. I'm obviously partial to DATCon. Terry Bradshaw is going to be there this year. I got my Terrible Towel already, my Jack Lambert jersey. I'm ready to roll as a lifelong Steeler fan. So mark that on your calendar. Would love to see you there. But with that, we are going to sign off for this week. Again, I thank everyone for listening. Really great conversation. And we look forward to seeing you next week. Bye, everyone.
Bye.